Hi, Martin Turner here. Welcome to our second lecture on Focus on the Enterprise. We first look at the cost of capital for operations, or WACC, including looking at the video Cost of Capital for Operations, one of the great videos available for weeks 9 to 10. And we see how the cost of capital for operations, cost of equity capital, and cost of debt capital interact. We also look at the key strengths and weaknesses of the economic profit model now that we are focused on the operations of our firm, and discuss what concerns you may have with using this framework when valuing your firm. And we consider whether we can develop sound, convincing judgments about our firms when arriving at a valuation of our firm. We then focus on levered and unlevered ratios, focusing on price to book ratios, and we see the video Levered and Unlevered Ratios. First, let's look at the cost of capital for operations for our firms. Hi, Martin Turner here, and welcome to our second lecture on Focus on the Enterprise. Last week we looked at how we can simplify our forecasting by focusing on the enterprise rather than on the company, so focusing on the operating activities. And we also looked at how we can express the economic profit model using abnormal operating income, focusing on the enterprise. Now, this week we're going to look at the cost of capital for operations, the weighted average cost of capital, and we'll also look at levered and unlevered ratios. Now, there's some great videos that contain a lot of the key content for these 2 weeks, this topic, and we looked at the economic profit for the enterprise in our lecture last week, and there's the cost of capital for operations and more on the cost of capital, and we'll have a look at the cost of capital for operations video in a minute. And then also there's a video on levered and unlevered ratios, which we'll also look at in the second half of the lecture, and also the benefits of focusing on the enterprise. So there's a number of they're just short videos that contain a lot of key content. So the cost of capital for operations, here's the short video on that, and then we'll discuss these issues.
The cost of capital is one of the drivers of abnormal operating income in the economic profit framework. Have you wondered what really drives the weighted average cost of capital? In this video, we look at how we include risk, the cost of capital, as one of the drivers of economic profit. We know that abnormal operating income equals the difference between a firm's operating income after tax and its weighted average cost of capital times its net operating assets. This can be restated as abnormal operating income equals return on net operating assets minus the weighted average cost of capital, all times net operating assets, where return on net operating assets equals operating income divided by net operating assets. In restating a firm's financial statements, we separate a firm's operating and financial activities and identify these key accounting measures of the enterprise of a firm: operating income after tax, OI, and net operating assets, NOA. The missing item is the weighted average cost of capital. When focusing on a firm itself rather than on the equity of a firm, we need to focus on the weighted average cost of capital, which is the opportunity cost of the capital required to fund a firm's operations, not the opportunity cost of the capital required to fund its equity. The operations of each firm will have their own unique risks. A firm will face potential risks such as risks in its markets from the actions of competitors, customers, and suppliers. Risks from changes in technology, changes in customer tastes, changes in demographics, risks due to weather, general economic factors, exchange rate movements, changes in commodity prices, risks from changes in tax and regulatory rules and requirements, and many other types of risks. Businesses face risk and uncertainty in their operations every day. Indeed, in business there are risks at every turn, lurking under every rock. The risks of a business relative to other investment opportunities determine the return that someone would require investing in the operations of a firm. This is a firm's cost of capital for its operations, or the cost of capital for the firm. That is, its weighted average cost of capital. It is usually called the weighted average cost of capital because it can be expressed as the weighted average of the cost of capital for equity and the cost of capital for debt. This will be a familiar concept for those who have studied finance. VE is the market value of a firm's equity in period 0. VD is the market value of a firm's debt in period 0. And VF is the market value of a firm's operations in period 0. Weighted average cost of capital, ROE and ROD, are related to each other by a simple expression based on the proportions of the market value of a firm represented by the market value of its equity and by the market value of its debt, or in other words, by a measure of its gearing or financial structure. The cost of capital for a firm's operations, the weighted average cost of capital, is the proportion of the market value of a firm represented by the market value of its equity multiplied by its equity cost of capital, plus the proportion of the market value of a firm represented by the market value of its debt multiplied by its debt cost of capital. You will notice that both equity and debt are at market value, not at accounting or book values. For further information on focusing on the cost of capital for operations, the weighted average cost of capital, go back to Chapter 6, Section 6.1 in the study guide, and also review Focus on the Enterprise weekly questions. Also answer, write and rate questions on Focus on the Enterprise in Peerwise.
So you can see that the cost of capital for operations, which we call WACC, or weighted average cost of capital, equals the weighted average of the cost of equity, cost of capital for equity and the cost of capital for debt. That's its relationship. And we can re-express that relationship in terms of the cost of equity capital equals the weighted average cost of capital, the cost of capital for operations, plus the value of debt over the value of equity times the weighted average cost of capital minus ROD, the cost of debt capital. So you can see that the cost of equity capital is affected by the operational risk, which is the weighted average cost of capital, plus the financial risk, which is the leverage, debt to equity, and the spread, the difference between weighted average cost of capital and the cost of debt capital. The key point about this to understand is that the costs of capital interact with each other. The weighted average cost of capital, the cost of equity capital, and the cost of debt capital. Now, we also saw that we also looked at continuing values last week, and we're having a good look at those. Oops, somebody's mic's up on, and we'll be looking at those in week 11 next week in more detail. And you can see these are the continuing values we'll be using in our spreadsheet. They're provided to you, and you can see these are perpetuities that we'll be making some assumptions around, and they can be perpetuities with some growth. And so you can see the DCF model, the continuing value CV, that's in T, that's at the end of our forecasting period, equals the operating income in 1 plus T in the next year, or times 1 minus G divided by RNOA, divided by weighted average cost minus G. And G is the expected growth rate in operating income. And RINOA, as opposed to return on net operating assets, RNOA, RINOA is the return on incremental net operating assets. In other words, on new invested capital after our forecasting period. And we can see we also have the continuing value for economic profit model, which is economic profit divided by weighted average cost of capital, that's a perpetuity, plus operating income T plus 1 times G minus RINOA, or times RINOA minus WACC, divided by WACC times WACC minus G. We'll be looking at those in more detail next week. But the key assumptions that we'll need to make in valuing our firm in terms of the continuing value will be the expected growth rate in operating income after our forecast period, and also the expected rate of return on incremental net operating assets after the forecasting period. So I'll be looking more on that later. Knowing where to start. When I've taught financial statement analysis, I think 5 or 6 years in New Zealand at MBA level, and then also about 4 or 5 years in undergrad. And we've been teaching it this year in the Bachelor of Accounting now. It's still in the teaching phase. But this is a past student. When I first started this unit, a real concern I had was that there was so much to know about a business and so many different things to look at when analysing a business, that I wouldn't know where to start and wouldn't be able to cover everything effectively. I found all the information and different techniques and considerations really overwhelming. But through the process of this unit, I've learnt that by breaking down value adders like abnormal earnings, economic profit, that's into the accounting drivers, profit margin, asset turnover, and so forth, it is actually possible to see what areas or activities or business are adding value, and to identify key drivers of value adding activities, key drivers of value adding activities. Focusing our time and energy into analysing these parts of the business means not only that we will save time, but that we will also be able to do a better job of analysing the parts that really count. So a lot of people feel like, wow, these businesses have got so much going on. How will I ever value it? Where our frameworks, the economic profit framework, discounted DCF framework, help us focus on key accounting drivers that are adding value within those frameworks. And this is all grounded solidly conceptually. And so that helps us to know where to focus in our business. That's what this person's saying. Now, the economic profit, we're using abnormal operating income now. The economic profit model, where we're focusing on the enterprise, has some key strengths. We can focus on the value add. That's what economic profit is. It's the value over and above the cost of capital, over and above the opportunity cost of capital. Abnormal operating income equals return on net operating assets minus the weighted average cost of capital, all times the net operating assets. So we explicitly consider the opportunity cost of capital, and so we need to make some estimates of that. We also focus on future earnings. That's the trip that our firm will go on if you invest today. That's the trip you'll go on. The past is finished. We'll focus on the key future economic and business drivers of a firm. So we use the accounting drivers to focus on what's driving them in that real business. And we focus on the enterprise, on the operating activities, as the key source of value add for most firms. So these are some of the key strengths of the model, and it means we need to understand our firm and its economic and business drivers, what's actually going on in the business. And this is key to accounting generally. Everybody who hasn't studied accounting knows this, I was having breakfast this morning just at the beachfront with my son who lives in London, and he's over visiting for a while. And we talk about various things, and he just said that it's sort of obvious that that's what accountants do, isn't it? That they use the numbers to connect to the business. and study accounting, you know, and particularly as we analyse our firms, you'll feel this happening. We can tend to just focus on the numbers. But we've got to we use the numbers to focus on the business. Now, some key weaknesses of the economic profit model is the difficulty or perhaps impossibility of predicting future earnings of our firms. No one knows the future for sure. No one knows the future very much at all, potentially. Our share markets, and so that's one issue, and that's one that quite a few people are thinking about. And you get some practice at doing it, you can form some views around that. The second is, are share markets efficient? When you studied finance, the efficient market hypothesis underpins our views on finance theory, and that hypothesis is that share markets are efficient all the time. In other words, you are not able to predict share prices. They are simply a random walk. So all the work analysing firms, identifying value price gaps and so forth will not allow us to build the market. Because a random walk means, which you would have studied in finance, means basically our best guess of the share price is its current share price. It's a little bit like dancing with a partner, and you're wondering where are they going to put their next step. And it might be completely unpredictable. You might be dancing with someone you've got no idea where they're going to step next. So what's the best guess of where they'll step next? Is it to the left, to the right, back, forward? Well, if you say to the left and then they move to the right, you'll be 2 steps away. And so you can go through that process, and the best guess you have of where they'll step next is where they are right now. So that's the idea of a random walk. We have no idea where they'll be moving next, where the share prices will go next. So if that's true, what is the value of trying to analyse firms and identify value price gaps to help us predict future share prices? And thirdly, this is the third point, assume the value price gaps we might identify will help us predict future share prices. So even if we can be confident that we've identified some value price gaps, the other assumption we make in the economic profit model is that that will help us predict future share prices. In other words, that over time, share prices will head towards the value that we've identified. And there's more in terms of key weaknesses, and this is one we're looking at this week. Difficulties in quantifying risk, the weighted average cost of capital. There's a real problem with finance theory, is quantifying risk. And it's an area with still a lot of work going on and not so straightforward. And also the difficulties in estimating the growth rates in continuing values. We're going to be estimating our growth rates in operating income after our forecast horizon, and we'll see that there's quite a lot of issues in estimating those. So I've got a question for you. What other weaknesses of the economic profit or valuation model might there be? I think I wrote it up. Yes. What concerns do you have with using the economic profit framework to value your firm? What's worrying you at the moment? I'll give you 1 minute. So just write something down. What concerns? You might say, I have no concerns at all. I think it's just the world's best model. Or you might have some things that are worrying you. Got 30 seconds to go. time's up, but you keep putting in your responses. Oh, Maria, would you like to take us through these?
Sure, Martin, I can do that. Okay, so I've got 4 on my set of slides here. It says, not knowing all the risks that a company has. So what concerns do you have with using the economic profit framework to value a firm is not knowing all the risks that a company has. That the process of making predictions through the economic profit framework requires experience to accurately or even nearly identify quantitative values of risk or growth of a firm. So that's sort of related to the first comment, I think. I worry that I might be wrong in my assumptions of what is really driving the firm. I have that same worry. And finding the value of operating income. So that's our 4 comments.
That's very good. Just keep them coming in. Well, in terms of the person who's concerned that they might be wrong with their forecast, let me alleviate that concern. You will be wrong. You know, forecast, if you did a forecast and it all came out exactly as expected, you'd go, whoa, that's spooky. You know, so we don't know the future. If I asked you what you're going to be doing this Saturday afternoon at 3 o'clock, you could probably say something, but then if I asked you next week what you did at Saturday 3 o'clock, it might be something completely different. So we don't even know what we're going to be doing in a few days' time. So how can we predict the future? We can't. So we're going to be wrong. But fortunately, it's not a game of being right or wrong. All you have to do is be better than average. Given most people in the share market aren't even looking at the firms and wouldn't have the skills, being above average is an achievable target, really. But yeah, so you don't have to be right. You don't have to be perfect. There's no answer. No one knows the future. You just have to be better than average at predicting the future. So we can sometimes at university think we have to get an HD or something, or a D to be good at something. Well, no, you just have to pass. You just have to be above average. That's how most things are, actually. And this game is like that. Now, in terms of some of the other concerns, we're going to be looking at some of those things. It's basically, hey, I don't have any experience. I don't know this industry. Sharon here has got South China Air. She barely knows where China is, let alone all the intricacies of the airline market in China and all the complexities. Chen from China here, he's helped her out a little bit on what's going on, but still, you know, we know so little about different industries, different companies. We may not have done all that much ourselves, you know. So how can people, do I have sufficient experience or knowledge? Or, you know, isn't this some sort of magic thing that you need to 20 years experience to somehow sort of get the juice, you know? So we're going to be looking at that sort of issue today. So these are the sorts of concerns you might be having. Here's some comments from some past students. The idea that hindsight is a beautiful thing was a theme that jumped out at me in this chapter. It's easy to look back at a company whose share price has risen and think, wow, that was a good buy last year. It was so obvious. It was so obvious. So because of X, Y, and Z factors, I should have invested. However, there are so many uncertainties in the market and general economy that it can actually be very difficult to identify X, Y, and Z factors as opposed to A, B, and C factors. Yes, with investing and in business generally, just running businesses, hindsight is a beautiful thing. Everybody's right in hindsight. Ryman Healthcare has been one of the most successful floats in New Zealand over the last 20 years. You've done 50 times your money. The institutional investors in the middle of 1999 didn't want to touch it. So it's a wonderful thing looking back, but the trick is to be able to make these decisions in business, whether it's investing or running a business today, going forward. So in investing in Ryman's, it was about investing 20 years ago. when it floated. How do we make those decisions? It's easy to look back. Hindsight's wonderful. Everybody's an expert in hindsight, but not many going forward. So how do we predict the future? To be honest, I'm somewhat sceptical of fundamental analysis. I work in a support role in an equity analyst team at a local stockbroking firm. When I started the job last year, I thought, great, I will learn about how to analyse companies in order to discover what they're worth and have first-hand exposure to a lot of this information. I thought that when an analyst's valuation of the company was greater than its share price, that I would know to buy the stock and I would be able to make a lot of money on the side. I made this assumption on the basis that eventually the market price of shares correct to meet a company's intrinsic value, or at least head towards it. Not only was that what I had learned at university, but also it seems to be a well-accepted theory in the commercial world and appears to be the reason for having equity analysts. But alas, my hopes were quashed when I realised that the equity analysts always seem to get it wrong. This concerns me because they are all intelligent people with finance and accounting backgrounds. Yet, despite spending their working days researching and analysing the companies they cover, they never seem to be able to come up with a valuation that the market price actually heads towards. So these are people who are doing it for a living and making good money out of doing these analysts. And this person, I do hear this from time to time from quite a few people, they see that it doesn't seem to work in the stockbroking firms. I don't know what my company will do next year. I don't know what the currency will be next year or what will happen to interest rates over the next year. Only God knows things like that, and at present he does not let me in on such information. But what I do know is what I think about my company's business, the areas of its business that drives value, and the external economic factors that will affect it in the future. I know what I think about it, what my judgments are, and why I have those judgments. By considering such areas and formulating opinions and predictions, I can gain valuable insights and give a sound opinion of value. That is my aim in this unit. So some people are thinking like that. They're thinking, well, I can make judgments with reasons, and let's see what happens. Well, one year, I've been teaching this quite a lot in New Zealand, but back in 2008, it was undergrad students, just like we're doing here. We had 100 or 120 students, but I picked these 7 companies. One was mine, but picked these 6 other companies where students came up with large value differences between the values they came up with and the share price, and I found their arguments convincing. Some people had the large differences, and I said, no. 1 or 2 I thought were a little bit, over the top and this sort of stuff, but broadly they were convincing. So I invested in one of them actually as well. Invested in Pumpkin Patch, I remember, just so that I keep focused on it. But I wrote these down right at the end of 2008. These are the ones. And then next year, and so they, for example, Harvey Norman, the share price in October 2008 was $2.50. And the student valued it in October 2008 at $3.80. Abnorm Healthcare, share price was $4.35, and the student valued it at $6.45. Pumpkin Patch, $1.13, the student valued it at $2.10. This is 10 years ago, October 2008. Reject Shop, $9.75, $17. Ryman Healthcare was $1.45 then, and I had a value of $2.50, and it's now about, I think it's about $14.50, 10 years later. Ansell, $12.90. They saw the value lower, $9.35. Convincing story around it. And Blackmore, $16.60, $25.20. So that was at the time. These are the ones that I found convincing. I invested in $1,000 something in Pumpkin Patch. Share price. So I looked at the share price September 2009 so that I could show it to students a year later. You don't necessarily expect to see these things working in a year, but in a year, the Harvey Norman, it was $3.99. Ryman Healthcare was $6.65. Pumpkin Patch was $1.95. Reject Shop $13.50, all in line with the general. The person who did Reject Shop had it a little bit ambitious, I felt, with their valuation the year before, but they were sort of broadly in line. Ryman Healthcare was $1.90. Ansell went down $9.25, and Blackwell's was $19.30. This group of 6 students and myself is 7. Just in a year, let alone having to wait a few years, were able to identify share price gaps in a way that I found convincing in their arguments. And then a year later, just a year later, the share price had moved towards their valuations, both either up or down. So some people are able to do this. And you don't need 20 years experience in the markets. But some people are better at making these judgments than others, I do notice. And a lot of people aren't used to thinking for themselves. What they're used to doing is asking people what they should think. I think I'll think what other people think. But some people are better at thinking for themselves. And that's what... so it's possible. Anyone can learn these skills, but few do. Anyone can. Few do. It takes interest, and some people are particularly interested in analysing financial statements. And but that's what I've learned over the years. I've taught quite a few students now financial statement analysis, and I've learned that. Before teaching it, I used to think you had to work for 20 years, a lot of judgments. It's not like that. It's a learned skill. But alas, my hopes were quashed when I realised that the equity analysts always seem to get it wrong. This concerns me because they are all intelligent people with finance and accounting backgrounds, yet despite spending their working days researching and analysing the companies they cover, they never seem to be able to come up with a valuation that the marketplace actually heads towards. So a lot of people who work in the markets aren't able to do this, but students at university can. I'm not really sure how well I will be able to analyse my company, but I know I will try my best and learn a lot regardless of how well I do. So you can badger your firm and then you can look at it in a year or 2 or 5 years or 10 years and see how it went. That's a good attitude. So we've looked at the cost of capital and some of the issues around forecasting our firm, which includes forecasting the cost of capital. And then we're going to spend a little bit of time looking at levered and unlevered ratios. And we're going to look broadly at the question, why do we need to be careful about interpreting levered ratios of a firm? Now we'll have a look at a video on this. So the video on levered and unlevered ratios, we'll look at that first and then we'll discuss it.
Have you wondered about the relationship between levered company and unlevered enterprise ratios? In this video, we look at levered and unlevered price-to-book ratios. Ratios of listed companies published in the financial media or supplied by the major providers of financial information are usually levered or company ratios. For example, price-to-book ratios are usually based on the listed share price of a firm's equity, the P, and the firm's net tangible assets per share, the B. A firm's net tangible assets will include both operating and financial assets and liabilities. Levered ratios include the effects of both the operating and financial activities of a firm. This means they can be influenced by changes in a firm's financial activities, even if there is no change in a firm's operating activities. For this reason, we need to be careful about interpreting levered ratios. We can express levered and unlevered price-to-book ratios as levered price-to-book ratio equals market value of equity divided by book value of equity, and unlevered price-to-book ratio equals value of net operating assets divided by the book value of net operating assets. The levered price-to-book ratio is the relationship between the market value of equity and the book value of equity. We know a firm's levered price-to-book ratio can be changed through changes in financial leverage. It is in part determined by how a firm's operations are financed. The unlevered price-to-book ratio is the relationship between the value of a firm's operations, that is the value of its net operating assets, and the book value of its net operating assets. This cannot be changed through changes in a firm's financial leverage. It will be unaffected by how a firm's operations are financed. The relationship between a firm's levered and unlevered price-to-book ratios can be expressed like this. A firm's levered price-to-book ratio equals its unlevered price-to-book ratio plus the effect of financial leverage. In other words, a firm's unlevered price-to-book ratio is its levered price-to-book ratio with the effect of financial leverage removed. If we think a firm's financial leverage does not affect value to equity investors, then a firm's unlevered price-to-book ratio will give a clearer indication of the relationship between market and book values for a firm than will its levered price-to-book ratio. A firm's levered price-to-book ratio will equal its unlevered price-to-book ratio when it has no financial leverage, that is, financial leverage equals 0, or where its unlevered price-to-book ratio equals 1. If the book value of a firm's net operating assets does not accurately reflect the value of a firm's net operating assets, that is, unlevered price-to-book ratio does not equal 1, as is usually the case, and if the firm has some financial leverage, which is also usually the case, then a firm's levered and unlevered price-to-book ratios will be different. For further information on levered and unlevered ratios, go back to Chapter 6, Section 6.4 in the study guide, and also review Focus on the Enterprise weekly questions. Also answer, write and rate questions on Focus on the Enterprise in Peerwise.
So there we have it. There are levered and unlevered ratios. And usually in the financial media and websites and so forth, they'll be referring to levered ratios. And we saw in the video that levered, we're focusing on price-to-book ratios. This applies to any levered or unlevered ratios we'd like to compare, but we're focusing on price-to-book, is the levered price-to-book ratio is affected by changes in financial leverage. So they'll change with different ways the business is financed, and they could appear to improve even though the operations are unchanged. If we think the financial activities of a firm are not adding value, then that's just noise in the ratio. The unlevered ratios are unaffected by how a firm is financed. And we looked and saw how the relationship between levered and unlevered ratios, and we saw that relationship. And so we can view unlevered price-to-book ratios, or any unlevered ratio, the unlevered price-to-book ratio as the levered price-to-book ratio with the effect of financial leverage removed. Now, Ryman Healthcare, if we change its financial leverage from, if its financial leverage is 0.4, then its levered price to book, based on the calculations I made, is 3, and the unlevered price to book is 2.4. But if we increase the financial leverage substantially, borrow more money, then its levered price to book can increase to 6.1, and its unlevered price to book is still 2.4. So you can see by moving the leverage, we can actually move these levered ratios quite a lot. And if a company is being assessed by the market and other investors on the basis of levered ratios, it can affect them by adjusting its leverage. In fact, you can double your levered price to book ratio, in this case, by gearing up the company a lot. But you see how the unlevered price to book stays the same, 2.4. And we also saw in that video that where the if the unlevered price to book ratios are 1, then it will stay the same at with the different the relationship between unlevered and levered is constant. They'll all be 1. So we've got the unlevered price to book there is 1, but you can see the levered price to book ratio is all 1, regardless of what the financial leverage is. And you can also see, in that previous table, how the levered price to book ratio, other than when it's 1, varies depending on the financial leverage. The unlevered price to book ratio doesn't, depending on financial leverage. So in other words, levered ratios, say a levered price to earnings ratio or levered price to book ratio, needs to be interpreted in the light of the impact of a firm's leverage on its earnings. So you need to be aware of those changes in earnings when assessing these ratios. All right, so we've had a look at the levered and unlevered price to book ratios as examples of how the levered ratios, which are common ratios often in financial media, are affected by the financial activities. If we focus on the unlevered ratios, we can take that effect away. All right, now we'll have a bit of a discussion about some of these matters, but first of all, what was the most important thing you learned today, and what questions still remain unanswered? Two minutes. Thirty seconds. And we've got 5 responses. You can keep them coming in. Maria, would you like to discuss these responses?
Sure. Okay, so what was the most important thing that you learned today? I learned that there is a potential for me to make an appropriate and convincing prediction of my firm's future value with the knowledge I can gain from this unit, providing I put in sufficient effort. That's very good.
That's great. That's good.
Then they've got the difference between levered and unlevered PB ratios is FLEV.
So what was that? That was the difference between levered and unlevered is FLEV?
Yep.
That's right. But it's more than that. It's financial leverage and spread. Spread is the difference between our returns and the cost of the... anyway, we won't go into that in detail, but it's a little bit more complex than just leverage. It's also the difference. It's the effective leverage is because you can borrow money more cheaply than what you can invest it in terms of your returns. So leverage is about those two factors. Ryman Healthcare has a lot of capacity to invest at higher than it can borrow at. So a little bit of debt has a big impact on ramping up its returns. But if you can only earn a little bit more than what you can borrow at, or say you could only earn the same as what you could borrow at, you can borrow as much as you like, it'll make no difference. It'll provide no leverage. So leverage has those two factors, but that's good.
We've got another one on the levered and unlevered ratio. So we've got levered PB ratio is the unlevered PB ratio without the effect of financial leverage. We need to be aware of changes in earnings when assessing ratios.
Yeah, that's great. So there's...
And then,
sorry. Yeah, sorry, go on.
And then there's two on, so furthering those concepts. So ratios reported publicly are often levered, which means they are influenced by financing activities, and that the levered ratio focus on the company as a whole, while unlevered ratios focus on the enterprise.
Yeah, they're great. There's some great insights. And so, particularly the first comment, some people are able to develop a degree of confidence at this stage that if they put in, they're prepared to back themselves in making judgments. I've got my wife and I shared a party, I think it was a week or so ago, and actually John came up from Bundaberg, but Maria couldn't make it. She's got such a hectic life. And but we had all sorts of people come from around the world, really, and locally. We had this big party, but my 3 children came. And one thing that strikes me about them is that they're prepared to back themselves. They're prepared to back themselves. And that's such a value, that confidence to be able to do that is a great thing. So some people sort of have that. They think to themselves, that's what this first comment is. They're thinking, yeah, if I put in this, if I actually have the time and effort, I might be busy doing other things, but if I put the time and effort, or at least follow it, I might be able, it might be possible that I could identify a price-value gap or come up with a valuation that's sort of credible. You see, you might value your firm and it might end up coming up similar to the share price. That's all right if that happens. Or it might come up very different. But the trick is to just value your firm, and then once you've come up with something you think is convincing, or, and you can discuss it with others, then look at the share price. That's what you do towards the end of the assignment. Don't sort of try and get the... And some people get a price that a value different to the share price, and they think they might have got it wrong. And some people get a value near the share price, and they think, oh, it must be right. Well, it all depends. The key fact to keep in mind is that in finance theory, just as in economics, it's based on various assumptions about what's happening in the world. They're very powerful assumptions that help us with a lot of analysis and views. But there's a huge difference between thinking the efficient market hypothesis is correct a lot of the time to thinking it is correct all the time. Human behaviour doesn't follow theories all the time, and markets don't. It's the difference between night and day as to whether these finance theories and economic theories apply all the time or most of the time. And finance and economics, there are theories and assumptions. There's nobody thinks who develop these theories, let alone the key people using them, think that they apply all the time. They're just useful assumptions for models. And that's the power of models, the simplification. That's the power of the economic profit model, for example, is it simplifies and focuses. It doesn't mean that it's everything. And the same here. So the efficient market hypothesis is a very powerful one, but it doesn't mean that it's true all the time. Ryman Healthcare has been able to make economic profits for over 20 years, and it's been listed, and it's been able to do it in the previous 15 years on a consistent basis. And so there you go. All right. Any other comments on that? Maria, do you have any comments on those comments? Any more?
No, it's very good. And we haven't got any more on the slides too. There's still just the 5.
That's all right. And we'll go to the next one. What questions still remain unanswered?
So there's 2. So how often should you review your financial statement analysis? Did you go back each year and reanalyze Pumpkin Patch Martin?
Well, this is a very good question. It's one of the sad things about life that I've found anyway, is that there are no shortcuts. Like my brother, he's an IT consultant in London. And he was over here for my birthday, for our birthdays too. He's still here actually. He's visiting my mum as well in Operi. And he is an IT consultant. And I remember years ago, he told me, he was in the shower one day, and it occurred to him how he could link. He was working for a large company, I think Cisco actually. He was working for a large company, and it just occurred to him in the shower how he could connect their product, with one of their products, with this new hot product that was floating around, and it's like a little connection. And so he wrote it down. He wrote it down. It took him half an hour or something. He gives it in, and it sort of makes the company $1 million or a couple of $1 million that year. And I thought, man, that's fantastic. You know, you can sit in the shower and come up with something. You can take the rest of the year off. And sometimes creative things can be like that a bit, but it's generally not like that. You've just got to do all the work. That's how I've got numbers of friends who have done well at different things. They've all had to work hard at it, you know. Where I've done well at certain things, I've had to work at it. It's very sad. That's typically how it is. We all want a shortcut. I just don't see it. And people who haven't got good at something can underestimate how hard people are working who are good at something. It's a bit like some sports person walks out and plays a game of tennis and they think they're just natural talents. Man, they've been working hard. Or some kid comes out and plays the piano really well or something. Man, they're working really hard. They haven't just worked. So it's the same here with the nails. It's just work. And what that means is, not only do you, in making an investment, say with Ryman's, you've got to keep track of it. And I remember when I did the Ryman's investment with the kids, also my wife, but I didn't keep track of it. It was just a sort of longer term thing, and I was busy with other things. But after 2 or 3 years, my youngest son was thinking he might sell because they'd doubled in price or something. And he thought, man, there's money here. And so I thought, I'll have a look at it. But I was teaching an MBA financial statement analysis unit. So I said, I'll give it to the students to have a look at. And then I'll also look at it, and I'll come back to you. So we did that, and we looked at it. And I came back to him and said, say it had gone from it probably was 27-cent stock, it had gone to $1, say. He was thinking of wanting to sell. And I said, I think in a couple of years it could be a $2 stock. So it is 10,000 shares. You can see him thinking he's probably about 7 or 8. He was thinking, man, you know, $1 was 10,000. This is 20,000. That was sort of like 200 million in his mind. And he said, I think I'll hold on. And then I used it. Then I thought, I'll keep using this stock because I'll keep track of it, particularly for the kids. You know, if they want to sell something, I'll be on top of it. You have to keep on top. So with your investments, the accounts come out every 6 months. So I look at the Ryman's 6-month accounts and then the annual. When I was teaching it actually in New Zealand, one of my colleagues, one of the professors in the university, was on the board of Ryman Healthcare. So he used to get me into the analyst briefings. I used to go to the analyst briefings, and now they sort of put the analyst briefings on YouTube or whatever, but you know, in the old days you had to go. And so I'd keep on top of it because stuff happens in businesses. They're moving, they're shifting. There'll come a time to sell Ryman Healthcare, and you know, or something might happen. You know, so I'm monitoring how it goes. I understand the shifts. Its return on net operating assets has been steadily coming down. down, 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 down. And but its economic profit is holding up because it's growing its net operating assets so much. Its return on net operating assets is still quite good, but it's not of the stellar levels that it used to have. So you can just keep track of these things. There'll come a time when people don't want to live in retirement villages. You want to be out of Ryman's well before that happens. It's got a lot of retirement villages. But there's no sign of that happening in the next 10 or 20 years so far, so we'll see. It's probably got quite a lot of legs on it. Also, one of the principles on this is really good businesses are difficult to find. So when you find one, you generally just want to stick with it. But you've got to keep on top of the detail, but you just let it run. You just start with Ryman Healthcare, been in there 20 years. I'd expect to be in another 20 years, 10 or 20 years. Just stay, because what are you going to do? You get your money out, you've got to find another really good business. And they're not easy to find, really good businesses. And it's the same when you're running businesses. It's very difficult to run them really well. And when you meet people who can do this well, it's most impressive. One of my friends, he was in video. He used to do video production and used to do stuff. And he used to work on oil rigs, actually, somewhere. He did all these odd things. But then in his mid to late 40s, he got into business. And he got into running a coffee shop in Wellington, sort of modern style coffee shop. And then he got into running a coffee business. He turned out to be really good at it. And he's made a lot of money out of running a coffee business. And I remember he took some of our mates, some of the blokes. We went around and we had breakfast at a coffee shop that they owned that was part of the head office. And then he took us through the head office. It was a new one. And I could just see how well he was running this business. Some people can do the business. So, yeah, there are skills. So the answer to that is yes, you need to keep, if you make an investment, you need to keep on top of it, because businesses are changing every day. There are risks everywhere. I'm sort of paranoid on that. And because I ran a private equity business for quite a lot of years, a lot of emphasis on due diligence. So we could get in the businesses and look at them carefully. But it's amazing what information is publicly available that you can focus on as well. And that's when you're in business, if you're running businesses or accountants in businesses or advising businesses, you've got to keep on top of the numbers and what's going on. Did that answer the question a little bit?
Yes, Martin, it's Yvette here. That was my question, and that does answer it. I was just really interested to know if you actually commit to this and you go, oh, this company is really cool. I got a good price. How often, do you keep checking in on it? Because obviously in a year's time, things change. So, but no, that was a very good answer. That answered my question perfectly. Thanks.
It also depends how much the investment's worth. Like with Ryman Healthcare, if you put in 20,000 20 years ago, which is not a huge investment if you've got lots of money sort of thing, well, it's worth $1 million now. Yeah, or more. Yeah, say it's worth $1 million. 20,000 is worth, $1 million is quite a lot of money for a lot of people. You want to keep track of it. It might be worth 500,000 tomorrow. You want to know. So the bigger the investment, the more time you spend on it. The smaller. Also, I think in terms of value investing, I think it means you don't invest in too many businesses. You just invest in a few, because it takes a bit of time to keep track. It also takes interest. If you're interested in business, you just love to keep track of it. And you can talk to people and find out stuff. That's all right. Okay, Maria, the second question.
Yep, there's still only two. And the second one is, I wonder whether I will be able to sufficiently understand the industry of my firm to identify the relevant risks of my firm and judge how those risks will affect the firm's value.
Yeah, that's a very valid concern. Lots of people will be thinking that. Also, when you do something for the first time, you never know whether you can do it or not. That's the reality, isn't it? So that's right. These are valid concerns. Some people, though, they're more confident. It's a bit like that comment maybe I can do this. Some people are more confident. Other people are going, I'll never be able to do it. It's impossible. Confidence is an important part of business and just anything. It's sort of like, I'm not talking about stupid confidence, those crazy people, but But confidence based on something is very important. Otherwise, you just won't do it. And you know, there's people who are crazily confident and they just run off cliffs. You know, not talking about that, but confidence based on something. I'm prepared to back myself. And yes, and decisions generally are they're always about the future. We do not know the future. This is correct. And it can be a bit terrifying, but you need the confidence to sort of back yourself to give it a go. And so there's sort of a balancing act between being stupid and being solidly based. But you know, if you start, some people are starting to feel, yes, maybe I could give it a crack. You know, who knows whether? Who knows? But you'll be able to tell looking back. But you know, I had definitely when I read the assignments, some of them will come across to me as being, yeah, I can follow that. That makes sense to me. That's convincing. And other ones will come across as, I think this person is crazy. They think that the world's economy is going to double next year or something, and I just can't see it, you know. But others, you go, yeah, I can see that. That could be right. Doesn't mean it will be right, but it's convincing. And so we make investments, whether we're within a business or investing into a business from the outside, we make them on our judgments about the future. We decide to work for some business or firm based on our expectations of the future, of what that's going to be like working with them. We might have done more due diligence than others, and we could be wrong, or we could be right. It's the same here. So yeah, put aside, you know, great doubts and just give it a go and see how it turns out. And it's just a learning process, regardless of whether you come up with a value that where the share price heads towards in a few years' time or not. A lot of people will come up with values that will probably be near the share price anyway. And they might come up with some very credible and sensible valuations. So, and other people will diverge from the share price. Did that answer the question a little bit? That question of confidence is an issue that you'll feel when you're doing it.
Yeah, that was very useful. Thank you.
Who was that?
Sarah.
Oh, Sarah. G'day. Any other questions you'd like to ask? Or what other questions would you like to ask? Well, we might have finished if there are no more questions. The assignment is obviously starting to people focusing a bit more on it now, as you perhaps have returned from doing other assignments. We can work on that now after class, and that completes our sort of. We're now totally focused on the enterprise, and that really helps. Analysis is about breaking things into bits and focusing on what the key aspects that are driving value in our business. And this is where we're using our two models to do that. All right, well, thank you very much. And we can break up into our groups now.